Welcome to yet another episode of Kreston Menon Perspective. I'm your host, Ajin Toney, and in this episode, we are asking a question every board eventually has to answer. When a business grows, is it actually creating value or just getting bigger? Joining me today is Govind Menon and Vivek Muralidharan from Kreston Menon Consulting.
Hi, Ajin.
How are you guys?
Hi, Ajin. Good. How are you?
Good. So, today we are diving into the topic growth beyond revenue, which looks at how founders and investors actually think about both inorganic and organic growth and what makes a growth story truly credible, and why the two sides don't always see growth in the same way. So, let's get into it. When a founder tells you a business is growing, what do you actually look for?
I think the first thing that you'd want to look at is a growth from a financial point of view. Is the revenue growing? Is profitability growing? But I think when you take a business as a whole, the financial metrics are just one part of it. I think when you're trying to look at things from a more larger lens, you look at a business from the market share that it is gaining, whether the business is entering into new geographies, if any new service lines or products are being introduced. So growth is not merely just a single metric, but rather it is a wide lens, a holistic viewpoint.
Right, Govind. As you mentioned, growth is a very holistic viewpoint. We can't just look at it from where we are yesterday and tomorrow in terms of a number sense. Value is created not just in terms of numbers, but in terms of the brand and the people, the vision. That's what essentially creates value.
Okay. So when you hear we grew 40% this year from an investor or from a, a business owner, what metric do you actually look at, or what is the specific number that you look at?
So beyond just a metric, the first thing that I would look at is how old the company is, how long it has been operating for. A company that is quite mature, that has been operating in a single market for quite a few decades, um, a 40% growth rate is an anomaly. But at the same time, if you're looking at a company that is very early in their life cycle, somewhere between 5 to 10 years, a 40% growth rate may be possible, provided that there are certain growth drivers behind it. Um, One of the reasons why we see a company in their mid-life having a large growth rate could be either due to entering new markets, or it could be an acquisition that was done where they're seeing a larger market share. So in reality, when you look at a figure such as 40%, I think you need to really delve into what are the growth drivers.
So just to add on to what Govind mentioned, the growth drivers beyond that, there could be two ways of growth, which is organic and inorganic growth. Now, organic growth is when the company is able to expand into different markets, it's executing itself better, and essentially compounding growth within itself. On the other hand, an inorganic growth is generally through, as you mentioned, acquisitions, mergers, or joint ventures. Now, each case has to be looked into it separately. So, when you use each case, an inorganic growth ideally would happen when the market is growing at such a pace where you're unable to capture that pace with an organic growth. So, you acquire a company that helps you capture that pace and expand into a larger market presence.
Okay. So what does a founder usually prioritize when evaluating growth?
This is essentially the a simple story where an investor and a founder come together, and both of them have opposing interests. A founder may just want an operational control in the business, whereas an investor would just want financial returns. But it could be the opposite as well. A financial investor or an investor might want to run the business as well, uh, while the founder may want to take a back seat. So it's very important here to understand the product market fit here, to see who is who here, and to find the right people, the right founder, and the right investor for the right reasons.
So adding on to what Vivek had mentioned, um, the priority for a founder would be on his operational control. When we look at any early stage founder, the real reality is something that you've idolized, something that you've grown, something that you've sort of brought from simply being an idea to actual reality. The core principle or the core idea that any founder wants to retain is operational control. that they get to drive the company to the direction that they want. The vision is theirs, and they just need the right support to grow it. And I think it is quite important that every founder looks at how they can retain that operational control and at the same time dilute enough of shares, dilute enough of control so that the business can grow at an exponential rate. And I think one of these live case studies that we really look at is from Steve Jobs. Um, very early on in his career, he, right after Apple had gone for an IPO, Steve Jobs had a situation where he lost his position on the board and had to exit the company. Again, this is a real reality for most founders where the focus is purely on growing their market. The focus is again purely on seeing the business thrive. That they don't really see how they can position themselves within the company in such a manner where the growth and the vision is still set by them.
Okay.
Right. Absolutely, Govind. Vision alignment is what can make it or break it, right?
Yeah. So, adding on to that, what actually makes a growth story credible to the investors?
So when a company grows, as Govind had mentioned earlier, obviously the stage, the maturity are critical. But what makes it uh, very credible to an investor is the consistency of growth. Uh, a growth may be just for 1 year of 40%, and the next few years are a degrowth. Does not give an investor much comfort. But consistent 10% or 5% growth rate year on year gives a lot more comfort. Now, this needs to also translate into other terms as well. The growth can't just be in terms of numbers, but it needs to be in terms of relationships as well. The customer relationships, if you have long standing customer relationships in a very critical industry, that gives credibility to the numbers. Whether your working capital days, whether your margins are kept on improving, uh, those are things that add credibility to any investor.
I would like to reiterate what Vivek had mentioned. Um, the real reality for credibility is actually the consistency, which is largely driven by how good the customer retention is. Any business at whichever life cycle or whichever or however they are placed within the value chain, the reality is every business is driven by customers. And the reality is every business is driven by repeatability of these customers. So naturally, when you have these one-off years where you get a large spike in terms of your revenue, I think you really need to discount these growth to a point where you know what can be delivered on a consistent basis.
Hmm. Right. So we would actually look at we quite often look at this from a quality of revenue perspective, where we are certain what could be the sustainable element of it, and to see whether is this reasonable and commercially realistic. Because quite often projections are made on certain heroic assumptions, uh, but all these assumptions need to be eventually grounded on commercial reality.
Hmm. Hmm. Okay. So, since we've thrown around 40% so many times in this episode, does such a high growth rate actually justify a higher valuation?
Not always. You could be growing at 40%, but you could be still losing money because you'll have to invest quite a bit of amount. Let's say you're not cost disciplined, or your margins are actually not growing as fast as your revenue growth rate. You're not creating value, you're actually losing value. So growth is only a growth of 40% is only possible when the returns are higher than the cost of capital. You essentially need to make more than you lose more.
Hmm. Okay. So, Vivek, yourself being from transaction advisory, how does transaction advisory actually test whether a growth opportunity is realistic?
So I would look at it from an angle of the future angle. Growth in the end, we would say, okay, next year we're going to grow at 20%. Now, how are we going to grow at 20%? These are based on certain assumptions. Now, we have to test these assumptions against commercial reality, whether be it from a pipeline angle, whether be it from a price volume angle, whether be it from a capacity angle, because we need to test each and every assumption to see whether is it commercially realistic. An example being, let's take the example of a biscuit manufacturer, and they are projecting for a 30% growth rate next year. Now, the entire market is only growing at 5%. Now, you could say that the first year, so they could have rapid expansion and a high revenue growth rate. But let's say in the first year itself, they are projecting for a 10% market share. Something like a biscuit manufacturer will have a very convoluted competitor base where having a 10% market share in the first year is unrealistic.
Yeah.
So we test those assumptions like that by comparing them into commercial reality. What could be the possible market share, which maybe could be around 2%. So we try to align that with commercial reality, and that's how we test the assumptions at KMEC.
Okay. And just to add on to what Vivek had mentioned, I think the real highlight is stress testing what the assumptions are. Because the reality is we don't really operate in a consistent market.
Yeah.
When you look at the GCC as a whole, um, there are periods of market growth, there are periods of market stagnation, and that same formula does not work in a market, let's say India or in the Europe. Every market operates in a different manner, but every founder assumes that there is a pattern of repeatability in every new venture that they take up. This reality to the market, to the founder's expectations, this gap is what transaction advisory can really bridge. So we test these assumptions in the real world. We test whether it is workable, whether these sort of returns, whether these sort of assumptions hold true with other market players. So we give them their business from a different lens. So this is what we really look at when we look at transaction advisory.
Okay. That's a wrap on this episode of Kreston Perspective. A big thank you to Govind and Vivek for joining us today. If you found this conversation useful, follow the show and share it with someone who's currently weighing their next growth decision. Until next time, I am Ajin Toney and thank you for listening.